So hello everyone and welcome to the IX training room with me, Richard Perry, market analyst for INFINOX. Now, we've got about 15 minutes or so, but before I get into it, I really do need to confirm with you the disclaimer, or a bit of a disclaimer chat basically, about the fact that I'm going to be talking about live market information, which means that I need you to understand that I am not giving investment advice. This is not meant to be investment advice. Please do not take it as such. Very important that you understand that this is just for your information only. So we've got, as I said, about 15 minutes. And what we're going to be talking about is basically what's going on in the markets at the moment. Markets are very choppy. They've been choppy since Friday and the non-farm payrolls data that massively surprised markets. And you can see I've got the S&P 500 here. We've seen that markets fell away quite sharply on Friday. If I zoom in, you can see that fell away quite sharply on Friday, and then has been choppy ever since then, basically. And the choppiness has sort of continued through this week as we've had a speech by Federal Reserve Chairman Jerome Powell. Now, Jerome Powell is or has been seen as the sort of obviously the man or the guy that sort of guides monetary policy for the Federal Reserve, and markets always take what he says very seriously. And markets have, ever since that payrolls data, markets have been thinking, well, is Jerome Powell going to be more hawkish? Well, the speech that he gave yesterday was not exceptionally hawkish. It basically was pretty much in line with what he said at the Federal Reserve meeting last week. Now, that Federal Reserve meeting, he basically said that disinflation, the process of disinflation was beginning. And that means that basically the Federal Reserve is in the process of starting to think about the end of monetary policy tightening. But he also said that further rate hikes could happen if on data dependency, really. So markets have sort of taken this, obviously with the payrolls report in mind, and they've just thought, well, maybe that means that the Federal Reserve is going to be now tightening interest rates more than we previously thought. And if you look at, say, for example, the CME Group FedWatch tool, which I like to look at, gives you a lot of good information about where markets are sitting in terms of interest rates. Now, this is for the March rates decision. An increase to 4.75 to 5% or 25 basis points is entirely priced in. Markets are guaranteeing that's going to happen. However, May is the important one. This one is now at 77%, there or thereabouts, for another rate hike in May. So 25 basis points in March, 25 in May, being 77% probability for May. Now, this is interesting looking down here, because that has jumped significantly over the course of the past week from about 30% up to over, well, 78% if you take these two in addition, really. So what we're seeing here is that markets are reacting to this, and with that bearing in mind, let me look at the graphical illustration of this. We can see that interest rate futures are now over that 95 mark. That 95 mark is the 5% line. Over 95 means that the market is sort of now starting to think maybe even, well, above 5% is being priced in. Also, that the first rate cut is now being pushed back into 2024, interestingly as well. So markets are moving on this, and there is, as I said, there has been sort of some moves whereby equity markets have been a little bit unsure on this, but interestingly enough, the key moves are coming through bond markets. Where are my bond charts? Bond markets, which have increased on the 10-year, certainly since Friday. Now, that 10-year is at a key level. Anyone who does technical analysis will know that this is now coming back towards a key moment. Look at this downtrend here that markets have been in on the 10-year since October time. Key sort of crossroads there. The 2-year has also sort of jumped higher, but is hovering around as well. It sort of seems as though markets are a bit of a crossroads moment. That downtrend on the 10-year being tested. This had a similar sort of move up back in December before falling away again. So this is a key moment. Is this now also seen as a moment where yields fall back again? We can see that the dollar index has rallied sharply, but it's again sort of chopping around. It's again, look at this resistance band I've got here on the dollar index. So 103.40 to 104.65, big overhead supply for the dollar is being tested now on that dollar index. So really important moment, I think, for equity, for forex markets there. So we've got those moves. Now, how does that translate to market moves? Well, let's have a look first of all at euro dollar. We've seen that euro dollar has retreated. That dollar strength that we've seen in euro dollar since Friday has sharply retreated the market back towards this sort of breakout area around this. I mean, the crosshair is basically at the breakout points that come around the 107.30 mark. So that again is a very sort of important crossroads here. The old breakout is supportive. That old resistance becomes new support, and we can see that in the last couple of days where we had this doji candle yesterday. Zoom in a little bit. Doji candle yesterday, and today market basically flat on euro dollar. So market is really having a think about exactly what this means. Very important moment. I think if it starts to sort of fall away again into the close tonight, the key support really does come in at 104.80 area on that euro dollar chart, but breaking down decisively below 107 would effectively open that 104.80 mark. But also, if I sort of zoom back out again, you can see here, this moving average here is 55-day moving average. Look how many times throughout the 2022 sell-off into Q4, that 55-day moving average was a basis of resistance. So turning back higher, it hasn't been underneath this moving average yet. And I think if that does go, that moving average, that would be a signal. That would be a signal for the euro dollar maybe starting to turn certainly more neutral, maybe even corrective, but more corrective it would be under 104.80, that reaction low that we've got here from the 6th of January here. So this is a really important moment. Does euro dollar hold this support? If it can hold on to this support, and we start to see, likelihood is that we'd see treasury yields falling over. If treasury yields do fall over again, then we're likely to see the euro dollar moving higher again, and that would be the key trade there. So watching out for treasury yields. If they fall over, euro dollar will start to move higher again. We can start to think about testing the overhead resistance, which comes in at the moment between sort of 107.80 and 108 big figure. Again, above 108 big figure on euro dollar would be a positive move, really a move that certainly on a closing basis, if that was seen, that would suggest this little corrective move has been seen as a chance to buy. The market is likely to then come back and test those highs again, that high that came in just above 110 big figure. So very important moment for euro dollar. Now, in terms of what we've got coming up that can affect euro dollar, well, on Friday, on Friday we've got the Michigan sentiment data. That could have an impact, something I'll talk about in a bit. But essentially, the next key data for US is now going to be on Tuesday with the CPI inflation. And if CPI inflation continues to track lower, and I'll talk about that in a couple of minutes. But if CPI inflation starts to track lower, then again that would help to pull yields lower for the US, and then euro dollar moving higher. We're in a similar looking situation here on gold. This gold rally that we've seen, sharp move to the downside that we saw Thursday into Friday. Market is sort of consolidated since then, just sort of started to now hold up a little bit. But again, these long upper shadows of this chart, let me just zoom in, give you full screen. These long upper shadows that we've had here suggest that the market isn't really able to find that traction in a move higher. It's just holding ground at the moment, just consolidating as those treasury yields have started to consolidate. Again, very important, if treasury yields do fall over, then we're likely to see the gold price rallying higher once more. So that support on gold that comes in, got the crosshair on it at 1860, that reaction low that we saw on Monday, that is the key support. If that gets broken to the downside, certainly having had 1, 2, 3 positive candles up from that low, the market then starts to fall over and breaches that support, then that would be, you could argue, even a bear flag, and you could probably measure it down to sort of the 1810 area from that, and that would be certainly back into the area of sort of trading that we saw back in December. But that support at 1860 on gold is a very important support near term. We've already got that RSI, the relative strength index, that's not looking as positive anymore, and that will be interesting again to see if that starts to sort of roll over and starts to turn lower. But that is a warning for me, that relative strength index, the RSI, but not yet decisively corrective. 1860 level of support is key. And finally, looking at those US equity markets, we said about the sort of uncertainty we've seen in the last few days, but this is all playing out within this uptrend channel that we've had throughout January. This is a pretty strong uptrend channel, considering we had the breakout through the resistance line, come back towards that 4140 level, which is effectively now, as I said, a basis of support. And you've got some good, pretty decent support between 4,000 crosshair, pretty decent level of support between 4,100 and 4,140. Again, and retreat below 4,100, that would start to really, I think, turn the market corrective near term, especially if it broke that uptrend channel support. And also similar looking sort of retreat and choppy nature that we've seen on the Nasdaq. Nasdaq futures have been choppy since Friday. Moved to the upside yesterday, but retreating again today. Effectively, it's sort of holding support around the breakout area. And what I can do here, a drawing of a basis of support. I'll show you here. This basis of support, really good, I think, basis of support there on Nasdaq futures there, between the sort of 12,140 up towards 12,370. Good basis of support there for any retreat. But you can see that with also the trend line that we've got here, the strong uptrend here, and that looks pretty strong. So anything back towards this uptrend is a pretty good buying opportunity, actually, I would say. But I think that is certainly looking as though it's consolidating. And again, the consolidation in itself is sort of a wait and see moment, a bit of a crossroads here for Nasdaq. And the fact that Nasdaq has been just consolidating, I think, and not really correcting hard yet. Equity markets are still uncertain as to exactly how to play this one. If treasury yields continue high, that's not positive for equity markets. We could see a deeper correction, but just for now, US equities are holding ground, and they're looking as though that it is still at a bit of a crossroads moment here. Let's come out of that full screen mode. And basically, I sort of looked at the economic calendar. Nothing really in terms of the economic calendar that we've seen until, I mean, this is this week, until we get to Friday, really. You got UK growth data on Friday. UK growth on Friday. Watch out for that early doors. That's certainly going to be pound volatility there. But then you've got the US Michigan sentiment, which Michigan sentiment has been sort of moving a little bit higher in the last few months. Can that continue? It's forecast to, I think, be around 65 on Friday. Where was it? I've got it here. yeah, 65. So just a tick higher. But as I said, the main market that we're looking out for, so the main calendar entry we're looking out for is next week with the CPI data. Now this is got here, change to bang, range, fly. And we've got next Tuesday, if I scroll down to next Tuesday, we have UI, which is expected to drop quite sharply on the headline and also on the core as well. So both core and headline inflation expected to fall quite sharply. So again, that would play into this, the whole sort of falling over of US inflation. The chart of that is here. You can see interest rates in the States now 4.75, now below average hourly earnings, below core PCE being the Fed's preferred measure of inflation. Not yet below the core CPI, mind you, I have to say. Core CPI inflation is expected to be 5.3, so still above the Fed funds rate, but obviously the inflation certainly on that chart is looking to fall away. So yeah, thanks a lot for coming today. Don't forget to join me next week. Again, I do this every week at 4 o'clock UK time. Thank you very much for coming over from Instagram, if that's how you got here, which is all good and helpful. If you're on YouTube, which I suppose you're all watching on, then don't forget to click on the bell subscribe button so you can get notifications for our videos and live broadcasts. So thank you very much for coming, and what I'll do now is leave you with a little video to explain a little bit more about the trading room and what we do. So thank you very much, and I'll speak to you soon.